What should I invest in? A practical guide to finding what works. This is a question I often get asked. What should I invest in? What should I put money into? How do I make sure I make a long-term return if I'm saving for a pension or whatever? And it's a question I'm going to look at over the course of this session. First of all, it might be worth knowing who I am. My name is Richard Nicholas. I'm an investor, share trader, and a lawyer. I am not a financial advisor, so I'm not going to be giving any financial advice over the course of this session. I'm only going to give you bits of information gleaned from quite a lot of studying that I've carried out in terms of learning different strategies, learning different ways of allocating money, and looking at some of the evidence behind some of those strategies. Acting as a lawyer, I've looked at a lot of different books, courses. I've studied in quite some detail some of the different asset allocation strategies so that you don't have to. I'll be showing you what I consider to be the best and showing you why and how you can very quickly check these out for yourself. Who's this for? This is for anyone who's looking to invest for the long term, for instance, into a pension, whether that's using a lump sum or just regular payments, anyone who's just working out what to do, and anyone who would like advice they can check for themselves. Everything I'm going to be showing you today, you're going to be able to check for yourself, and I would strongly encourage you to do that. Don't take my word for it. Who on earth am I, for goodness sake? Have a look at the people who've actually tested what I'm saying over many years, because only that way will you find out something that you can properly rely on. So what should I invest in? That's a question that many people ask. Who on earth can you ask that question of? You might be looking to ask people that you know, family members, people that you believe are doing well. You may even be tempted to speak to a financial advisor. The problem with all of those things is that people focus only on what they have experience of themselves. Many of your friends, contemporaries may have done well in Bitcoin or gold or cannabis or whatever the latest hot fashion might be, and may consider that they've done very well and that therefore you will as well. But how do they know whether you're going to do well over the long term? Similarly, speaking to a financial advisor. Financial advisors are great, but some of them, as we've seen over the recent few years, are simply interested in products that they can sell. And unfortunately, we've seen many examples of that in the UK recently, where financial advisors, supposedly independent financial advisors, have been selling products even after funds are quite clearly about to be wound up. And many investors have lost out as a result of that. And the difficulty is that many financial advisors are paid by commission, paid as a result of the products they sold. And that's something I hadn't realised for some time. I'm looking in the papers, looking at consumer magazines, you'll often find various recommendations by financial advisors, and you might compare several of them to see who advises what. The problem is many of them are paid by the same financial product providers, and so many of them will come to the same recommendations. Doesn't mean it's a good idea necessarily to invest that way. So who can you trust? Well, you can probably trust the results of your own eyes. And I would suggest that there are some questions that you ought to be asking of yourself. Try something for a moment. Put your hands out in front of you with your palms up. And I would suggest there are some questions on the left-hand side and some questions on the right-hand side that you need to be asking yourself. Questions on the left are all to do with you. What do you want? What do you want ultimately in terms of your goals, your aims, your ambitions? What do you want from your money? Looking at the right-hand side, you're asking slightly different questions, which are what works in the market? What works in terms of making a long-term investment? And how do you prove that? So looking on the left-hand side in terms of what you want, there are some questions you need to be asking yourself. Only you can answer these. When do you want the money? That's a key question. Do you need it in 2 years, 5 years' time? Are you saving for children's education? Are you saving for a particular event, such as retirement? What are you investing for? Only you can answer that, and you need to work out, therefore, how long you need to be invested for, how long you want to, when you want to draw on that money. How much do you have to invest? Depending on how much you have to invest, might determine what you can invest in, and therefore how much that's going to cost. How do you feel about risk? How would you feel if you were to lose 20 or 50% of the investment in one go? Many people would feel really, really quite sick about that, in which case you may want to keep risk fairly low. And finally, how much time are you prepared to spend on investing or making an income? If the answer is really not very much, then you're going to be looking probably at a sort of buy and hold strategy, and that's what we're going to be looking at today. But there are ways of making a significantly higher income if you're prepared to spend a bit more time working on or keeping track of your investments. But the other questions you need to be asking about: what works? Which strategies work in terms of what makes a long-term good return? What keeps risk to a minimum? Why do they work? How do they fit together? And what evidence is there? I would suggest these are questions that you need to be asking of the market, of the experts. How can you prove to yourself that these strategies work? I'm going to be showing you some today, and I'm going to show you exactly what evidence there is, because I'm going to show you exactly how you can look that up for yourselves. So in this session, we're going to be looking at very little at what do you want. I'm not a financial advisor. Only you can answer those questions. I've got some questions for you to answer as a download, which might help you to make that decision. But ultimately, that one's yours. On the right-hand side, however, I am going to look at that. What works? Is there a strategy that works? Can we explain why it works? Can you understand why it works? How does it fit in with everything else? And what evidence is there that it works? And ultimately, what you'll find is a strategy that works for you, bringing those hands together. So let's start with cash. As you're probably aware, cash loses value over time as a result of inflation. There has been inflation for many, many years now, and the effect of it has been that cash has lost much of its purchasing power. So the same amount of money that would have bought something worth $700 back in 1940 will only now buy something worth about $50 now. So that's quite considerable. Holding money in cash will mean that the purchasing power of that cash diminishes over time. That's because the price of things, houses, property, goods, food, go up over time as a result of inflation. And it's the same in the US as it is in the UK. So what goes up? What beats inflation? Well, there are a few things. You can see cash here, the $1. This line here, the straight line, $1 doesn't change over time, and you'll see by comparison inflation rises, which is why, of course, cash falls in values, because inflation rises like this. You're looking for something that beats that. And here you'll see two things that usually beat that over time. The first one, the orange line, is bonds. Now, bonds tend to go up fairly gently over time. Bonds are basically an investment in a company that often will pay interest on that and will repay money over time. And they tend to go up relatively slowly, but they tend to go up reasonably consistently. By comparison, you'll also see stocks, in other words, shares and stocks in the stock market, company, part ownership of a company. Those, as you'll have seen, from 1926 to 2014 and continued since, have gone up quite considerably above inflation. So have done considerably better than bonds or indeed cash. And that has been the case year upon year. If you Google the Barclays Equity Gilt Study, that's a Barclays Equity Gilt Study, you'll see that each year There is a study looking back over the decades to see what does better and how it does, comparing stocks, bonds, inflation, gilts, and various other assets. And typically stocks do the best of all of them, usually head and shoulders above the others. However, you'll see that that isn't always the case. If you look over here in 1934, this year here, which is about 1936, and various other years, you'll see that there are dips. In other words, where stocks have fallen in value, sometimes fallen quite steeply. In each of those years, if you compare them to bonds, you'll see bonds, by contrast, have hardly budged. They have tended to slowly and surely creep upwards. So you might consider that if you're looking to get the best return and the smoothest return, in other words, having low volatility over a certain period so that your portfolio is not going up and down too much in price, you might consider having a mixture of stocks, in other words, shares, and bonds in your portfolio. And that's typically the advice that a financial advisor might give you. Sometimes they'll talk about having 60-40 split, depending how old you are. And the 60% shares and 40% bonds, or indeed 100% less your age, so 100% less your current age in bonds. So if you're 40, the older you get, having more bonds in your portfolio. But is there a better way? Is there any proof? Is there actually any science behind this asset allocation? Well, a chap called Harry Brown looked at the typical asset allocation between bonds and shares, and he looked at the fact that shares tended to do very well in times of inflation, relative inflation, whereas bonds tended to do fairly well in times of deflation when the economy is sinking. He saw that these two things did set each other off fairly well, but he also recognized that there was another force in the markets as well, and he said the other thing that affects how well assets do is high interest rates and lower interest rates. And taking those four things together means that what you end up with is four different things that do differently in different markets. So cash doing well when there's a period of deflation but high interest rates, bonds doing well in a period of deflation and low interest rates, shares doing well in relatively low inflation but lower interest rates, and gold doing the best in times of high inflation. And for gold, you can sometimes substitute property or real assets, things that have a value that are physical. And those four things, as Harry Brown found out, actually combined quite well because they did they performed differently in different times. And when one was going up, another would be going down, meaning that they balance each other out and would altogether go up over time. And his suggestion was to have 25% in each of those four different assets: 25% cash, 25% gold, 25% bonds, and 25% shares. Now, he recognised there may be better ways of doing things than that, and he did try better ways of doing that, different ways of doing that, but he came to the same conclusion at the end that actually 25% made it simple, easy to follow. He said you have 25, the strategy is 25% in each of those four things. So if you have a lump sum, you put 25% in cash, 25% gold, 25% bonds, 25% shares, and each year or regularly, what you would do is, as one of those things might go up, so for instance, if there's a period of high inflation, if gold goes up in value significantly and becomes 50% of the portfolio because it's gone up in price, then you would sell the excess and reinvest in the other three things, so that it rebalanced back to 25% in each of those four areas. And that rebalancing meant that risk is kept to a minimum, your portfolio grows over time, and it remains balanced. And that was the Harry Brown All Seasons portfolio at a glance, 25% in each of those 4 types of asset. Now, I don't expect you to take my word for that. I would recommend this book, which is Harry Brown's book, which sets out the portfolio. You may also come across a very similar portfolio put together by Ray Dalio sometime later, which is described in Tony Robbins' book, Money, Master the Game. That has a higher asset allocation to bonds, smaller one to cash. But actually, you don't need to compare those two and come to your own views, because this book, which is probably one of the most boring book titles you might ever come across, it sounds like a physics textbook, actually does that work for you. Global Asset Allocation by Meb Faber. He looks at 6 to 8 different asset allocation strategies, including both of these, and looks at which ones are the best. And he says that these two are virtually identical. They've got very similar asset allocations, very similar to put in practice, and they do considerably better than the other asset allocation strategies. And all of them, interestingly, all of the different strategies do better than had you bought from a financial advisor and paid a commission. Because what makes a bigger difference to everything is actually how much you pay for the investments in the first place. So there you have it. If you're going to invest over the long term, I would recommend the Harry Brown All Seasons portfolio, and you can find the reason for that in this book, which looks at various portfolios over time and compares them all against one another. So what do you do next? Well, for the long term, set and forget savings, the money that you're going to save at the long time, it would be worth having a look at Harry Brown's All Seasons portfolio and Ray Dalio's All Seasons portfolio. They are very similar. Compare the others and see what you think. At the very least, it's going to be worth reading this book on the left here, Meb Faber's Global Asset Allocation, because it looks at all of the different strategies, gives evidence, and shows you why they have done well over time. For each of those different things, so for the gold, for the stocks, for the high quality bonds, you can buy exchange traded funds. Exchange traded funds are basically stocks on the stock market that track each of these different things. They track gold, they track stocks, track bonds, and rebalance every year. What that means is your risk across the different assets is reduced by what's called diversification. In other words, you hold different things. You don't have all your eggs in one basket, you have them in 4 different baskets. And if you're not intending to look at your savings again, then that's a sensible strategy. It's a sensible strategy because, at the very least, you've got 4 different things, and some will go up at different times. And if you're going to forget about them, if you're going to not look at them, then that is the best way of reducing risk. But what if you want a better return? You can do better. You can do better by choosing to trade stocks. In other words, choosing to buy shares when they're low and sell when they're high. You do need, though, a strategy and a plan. You also need a bit more time. By trading stocks, you are going to spend a bit more time looking at stocks, working out where they're going, and buying when they're low and selling when they're high. And you're going to be working out where they're going. You're not going to need a lot more time. 30 minutes a week should do it. So an hour to 2 hours a month is probably all you need in order to trade shares. One of the good things about looking at Harry Brown's All Seasons portfolio is that you're able to compare your trading with that portfolio. If you can't beat it, ultimately stop. If you can't beat the All Seasons portfolio, then you shouldn't be trading. You should be investing instead, and just put your money into that, and you know that you'll do reasonably well over the long term. But it is possible to considerably beat that portfolio by trading shares if you're prepared to spend a bit more time. So one thing you might do is to keep some savings in the All Seasons portfolio and to take a bit of it, and decide to try trading that proportion. It should take only 30 minutes a week, 25 hours a year, and you can monitor your progress against the other money that's in the All Seasons portfolio. Compare one with the other and see what's doing best. If you'd like to try that, you might want to join me in the next session, where we're going to be looking at how to understand charts, how to manage risk, how to get a better return than buy and hold, and I'm going to introduce you to a very simple trading strategy looking at the charts. So that's the next lesson. You can find details of the strategies and more information at anywheretrader.com. The next lesson will be looking at understanding charts, managing risk, when to invest, and in particular, when not to invest. Sometimes to be in the markets and sometimes when you don't want to be in the markets. And I'm going to show you how to avoid big crashes, because that's something that many people are concerned about, is how to make sure they don't lose money in the markets. And I can show you that as well. Hopefully you'll join me in the next lesson. Thanks very much.